All right. Okay. Good evening, everyone. Okay. Welcome to today's session. Right. Great to be here today. And of course, today's session is sponsored by KVB as well. Right. So really appreciate the opportunity to KVB for having me. And of course, having you guys here as well to talk about the markets. So I think before we begin, just some quick housekeeping. Of course, everything we'll be covering in today's session are solely based on my point of view, and they are based for educational purposes, right? Though we're gonna talk about the live markets, it's gonna be a very, very casual session, right? The previous session last week, we cover a bit more in depth into the topic of DSC framework, right? The techniques I use to analyze and trade the markets. Today will be very much on the application aspect, right? So we'll dive into the charts, talk about the markets, do some analysis for you guys as well, all right? And of course, if you are joining us live here, so I do see here LKW84 as well as Ram, if I pronounce your name correctly, Ram or Ram. Hello, right? So to make full use of the session, feel free to use the chat feature. You can ask any questions related to trading. You can ask any questions if you have any particular instruments that you like me to go through and share my insights on. Feel free to just drop it into chat, right? I'll be keeping track on what's happening on the chat, the questions that you guys have as well, right? Yeah, so another part that I just want to very, very quickly cover, okay, it's to share with you guys the current promotion that the KVB have, right? So in case you're not familiar, there is this option called switch bonus, right? So of course, if you like find out a little bit more, there are link attached to the description below this live stream as well. Feel free to just click onto that. Then of course from there you can actually inquire more with the support team as well, right? But today I just want to bring your kind of awareness to at least, aware that there's such things or such promotions that they're doing, at least from now until the end of this year. Okay, so there's this switch bonus, which is very unique. So if you just want to understand a little bit more, you can click on participate. I'll just go through the basics of things. There are a couple of steps, obviously, right? But what's interesting and unique about this is, of course, we might have, our own various platforms that we're trading on. And right now, this promotion here is basically today, if you're new, right, and you decide to start your trading journey here with KVB, they do reward you with the bonuses over here, right? Which you can see step one, step two, step three. And of course, there's also the double rewards option, right? So again, it's pretty straightforward. If you like to take part in this, again, the links are being attached onto the description in this video. Feel free to click that, and then if you have further inquiries or questions onto this, just feel free to reach out to the support team. Right, they'll be more than willing and happy to actually assist you on this. Okay. Um, Great. So with that said, and of course with the disclaimer done, I'll just do a very, very quick introduction about myself, just in case it's the first time you're here and maybe you miss out last week's session. Okay. So my name is Yong. I've been trading in markets since 2012. Personally, I've come across many different techniques, right? And this ranges from the technical aspects where we talk about indicator base, we talk about chart patterns, all the way to fundamental analysis, sentiment analysis, where we look at like really short term things like news, and of course, risk on, risk off, and things like that. Even looking into like seasonal data trends, right? So seasonal analysis as well. So yeah, I've pretty much experienced quite a lot of different techniques, right? And today I've actually settled down to the DSC framework, which is a very, very universal framework that I believe all traders would need in order for them to approach and trade the market in a consistent fashion, right? And of course, if you missed that, you can watch the replay that we had last week, or alternatively, right, next week, we'll do another session on that, right? And I would strongly encourage you guys to join in on a live session because you can then interact with me, ask questions as well. Okay, and I like to give live examples, right? And today is something that I love doing, okay, because we go into the practical aspect, okay, and not so much on the theory part of things, okay, and you can really see how the DSC framework are being applied in the live market, right? But of course, I'll just do a very, very quick summarized version as we go, okay, for the benefit for those of you who actually missed out last week, okay. Yeah, so that's my take and the approach of things. And of course, I use a lot of Elliott wave principles in today's approach towards the market. I've combined it with what we call the smart money concept, SMC, right? Or some traders will call it ICT, to actually look for setups and trade the markets as well. Okay, so again, if you're fairly new to these principles, and if any questions, as I mentioned, just feel free to drop it into the chat. I'll kind of like look into the questions and then answer yours accordingly. Okay, good. So with that said, I'll jump into the charts over here, right? And we'll kind of do the analysis as we go, and I will then also, okay, let me just bring up a empty chart first, right? We'll do the analysis as we go, and of course, I would want to very, very quickly do a summarized version of what the DSC framework stands for. Okay. Now, as the terms here says DSC, right? So there's generally three components in this framework, right? The first one is what we call directional bias, right? Which in a very, very short and simple understanding, you need to have a directional bias in order for you to actually analyze and trade the markets, right? If you have no methods to identify a high probability direction, then you struggle in your trading, right? Because you do not know whether you want to focus on the buy side of things, or sell side of things, or to stay away from the market. Okay. So the way I actually decide the directional bias for my trade is I use Elliott wave principles, right? Chart patterns that tends to repeat itself over and over again to project, would price highly likely go higher or highly likely come down, right? So that's the directional bias, right? Which you will observe and you'll be able to witness how I apply this in today's analysis, right? Then once we have that, that's where the S comes in, right? Which is the setup that tells us the criteria and conditions that we need in order to execute a trade, right? Or AKA sometimes I'll just call it timing, right? Again, what this means is that if today you have been trading some time, you will then experience, having the right direction is not enough, because sometimes you would realize, you take a trade, the market hit your stop, and then eventually it goes in your direction, right? So actually, the direction is not a problem, right? You get the overall direction correct. But what then needs to be improved on is your timing, right? When you actually get in. Okay, because if you get in a little bit later, you would have been a profitable trade. But if you get in a little bit too early, you might get stopped out first, right? So when you start to realize things like that, then it's actually not so much about the method of deciphering the direction, but it's more of the setup that you use needs improvement, right? So that's what I mean by setup. Okay, basically a set of conditions and criteria that you need to see before you execute a trade. Okay, and for me, setup over here, I'm using the SMC model, right? Which again, I'll share with you today over here, because we do have a couple of, I would say, opportunities that might trigger within the week itself, and trades that I'm personally looking to take. Okay. And the last component in this framework is essentially contexts, which are basically elements that help to improve on your entire probability of trades, right? Whether is it multi-time frame perspective, whether is it confluences that we see, risk management perspective, exposure in your overall portfolio and things like that, right? So context helps us to gel everything together to help us make a decision on how much risk am I taking, right? How confident I am on this particular trade. Would I still want to take it, or how am I going to manage this trade? So those are element of context, right? So the framework over here, as you see, right, DSC, it serves two purposes, right? One is it gives you a framework, a process to approach the market. Number two, it gives you the clarity in understanding what are the areas of improvement that you can work on to achieve consistent kind of performance in your trading, right? So there are many methods that you can fit into this framework, okay? But the idea is today, if you would like to achieve consistent outcome, this is something that you need to have as a whole, right? That's why I say it's a universal framework, okay? So with that said, right, let me jump into euro dollar, right? Or in fact, I'll start with Aussie dollar first, okay? Because this would give you a full picture of how this entire framework is being applied. Now, my style of trading is a swing perspective, right? So I'm not so much into like intraday or short time frame. I'm very much more on the slightly higher time frame, which I use the H4 as well as the H1, right? So very, very specifically, I use the H4 to help me identify the overarching direction. And I use the H1 to identify the conditions that I need for a setup. Okay. So I go top down, right? I start from a higher time frame. Do I have a clear direction that I'm looking at on this particular instrument? If there is, I'll then drop to the lower time frame and see if do I have a setup? Do I have the conditions that I can to take a potential trade? Okay. So let's look at euro dollar here on a 4-hour cycle. Okay, now there are some elements of Elliott wave that you can see on the chart here where you have like, W, X, and Y, right? So I might not have the time to dive very deep into that. But of course, if you want to understand a little bit more about Elliott wave patterns and things like that, do join us next week, okay? So what we see over here, right, based on my analysis on Elliott wave principles, okay, we are kind of anticipating the market to pull back. And after this pullback is completed, we are projecting that the market would likely make another move lower and potentially test back this area, right, which is around 0.6440. Okay, as long as price respect this high, if you can get a corrective pullback, we can have a high probability where the market come down lower. Okay. Now, what I mean by corrective, right? Just for the context of everyone understanding the same thing, corrective is essentially describing that the market is doing a pullback. The market is developing in a slower fashion, right? It doesn't have a lot of momentum, right? So if you do a quick comparison in price, right? This move down is fast, right? So that's what we call an impulse move, very fast move, right? This part here that I circle, right? This is corrective, right? Because you can see the market is not really going up very fast. There's quite a bit of an overlapping move. That's what we call corrective. Okay. So as part of the patterns that we recognize in Elliott wave, if this is going to be a corrective pattern, then there's a 70% chance the market will likely continue lower, right? And that's what we are establishing right now. Directional bias, right? If we get a corrective move, we are bearish bias. Okay, so kind of start establish that overarching focus and direction I want to see, right? Now, so if at least for the midterm perspective, right? At least for like the remaining part of this week as well as going to maybe early next week. Okay. If my focus here is to look for bearish bias, right? Looking for bearish perspective, then my setup would naturally means that I'm only interested in sell trade setup, right? I'm not interested in buy opportunities. I'm only interested in sell. Okay. So I do see a question here. Let me cover this, then I'll come back to your question very, very quickly. Okay. So once I establish my bias, right, what I'll do is I'll drop down to the hourly time frame, right? So let me just open up the hourly time frame over here. Now, obviously, there are some drawings that I've done already, but let me just erase everything, right? So what I do here is I blend in the principle of multi-time frame. Okay. So why do I do that, right? What's the advantage of analyzing it on the 4 hour and then using the lower time frame to look for execution, look for setup? The main advantage of doing that is that in a lower time frame, number one, we can wait for more confirmation. Number two, we can actually structure our trade such that the risk to reward ratio is bigger. Okay. Why? Because on the smaller time frame, naturally our stop loss is going to be tighter. And then we can use the higher time frame to actually put our targets, right? We can aim for a higher time frame take profit level, and then that would significantly increase the risk to reward ratio. Okay. So that's the two primary reasons. Okay. So today, what are the setup that I look at, right? Now, again, I'll just do a very simple summarized version of SMC model. Okay. Now, today, if I want to sell, okay, ideally, I want to see something like this develop. Okay. So this is a classic kind of SMC model where we have what we call a liquidity sweep, kind of a thick break to the upside. You can see over here. And then the market comes down very fast with momentum and it breaks this low. All right. So when that happens, what we have in SMC is called a breaker structure, or some traders will call it a changing character, right? CHOCH. The term doesn't matter, it's not the most important thing, but the principle is, okay? So you want to see an impulsive break. Okay. Now, when this market comes down very, very strong, oftentimes in SMC, it's either going to leave behind what we call a fair value gap or an order block, right? And of course, oftentimes it's going to be somewhere there, right? Near the top part of things. Then what I want to see is the market pulls back and it needs to pull back correctively. You cannot pull back too fast, right? And then I'll combine it with a fib, right? And for me, this fib here, I'm using a little bit unique fib, right? Which is 67% retracement is my entry. And I wanted to see a confluence with either a favor gap or a order block. Okay. And of course, my stop is just going to be above this previous swing high if I'm looking to sell. And then my first take profit would be where that swing low is. Now, I can go for external or extended target based on a higher time frame, right? But the bare minimum take profit one is always going to be where that swing low is. Now, the beauty of this using a very systematic and kind of a Fibonacci ratios to actually look for setup is that your risk to reward ratio is always going to be very consistent, right? So based on the 67 entry point with 100% as a stop and a 0% as a take profit, our risk to reward ratio will always be an average of 1:2. Now, for those of you who don't understand what this means, is that if today your risk reward is 1:2, every 1% you're risking, your profit target, if it hits, you're going to make back 2%, right? So it makes a lot of logical sense to take trades based on this, because if you only have a 50% win rate, you will still make profits off the market because of your risk to reward ratio, right? If today you increase your win rate to about 60%, okay, and you go and calculate every time you risk 1%. If you make an average of 2%. If your win rate is 60%, you actually can be very, very consistent and profitable. Okay. So this is the classic SMC model that I want to see, right? So you can see it's a very, very systematic approach because I need to have condition one, condition two, condition three. And then when all things follow through, I have a trade. Okay. Now, bear in mind, of course, the market conditions are not going to be perfect all the time. Sometimes you might miss out on liquidity strip. Sometimes you might not have certain elements. It's fine. We're not looking for perfection, but at least you want to have majority of your criteria being fulfilled. Okay. At least the market needs to give you at least like maybe 80% of the conditions there. Okay. Now, sometimes we might not take the very, very first kind of U-turn, right? Sometimes the market might continue lower. And then when we come in, the market is somewhere here. Okay. So in this case, you can see that we already have some sort of an internal trend being established, right? You already have this high, this low, you have a higher low. Sorry, you have a lower high and then you have a lower low. Okay. Now, when this is being established, obviously there won't be a liquidity sweep because we already have an internal downtrend. All right. Now, in this case, when we already have an internal downtrend, right? Now, obviously, this is a break of structure because the previous low has been broken. All we then want to observe is, do we have some sort of order block fair value gap around here? We don't really need a liquidity sweep anymore because we already have the downward trend established. Okay. So that's the slight difference in terms of the criteria. But other than that, everything is the same, right? We wait for price to pull back towards the 67 and then we'll look to take the trade down. Okay. The risk reward ratio is still going to be there. Okay. So that's the setup, right? So there's a slight variation if you're looking at the first U-turn point, and then second, we're looking at an internal trend has already been established. Okay. So now if I bring you back to where the Aussie dollar is. Okay. So very, very quickly, I just want to show you how this model is being applied, right? Now we have this high. Previously, we have this tiny high, right? Obviously, this is some sort of a potential liquidity sweep. The market came down, break the structure. Now, initially, we were expecting this to go up and then we can look to sell it, right? But of course, the market did not come towards our entry point or did not come towards our entry zone. But what happened next is that the market continued to drop. And then now we have this high, we have this low, we have this high, we have this low. The market is doing a pullback. What do we have? We already have an internal trend structure, right? Which I've just described just now. This is essentially your breakup structure. Okay. And if this is your breakup structure, this is your swing high. What we can do is we can take fips from this swing high, map it to that swing low. 67 is potentially where we're looking at, right? Now, obviously, it's not the cleanest of all right now, but you can see that there is a little bit of what we call an order block around that area, right? Now, how do we identify order block? It's essentially, while this is coming down, every sort of a pullback here is potential what we call an order block, right? So you can see this is a pullback before the next drop that break the structure. So this is pretty obvious to me, a significant area, right? You can even think of it as potential resistance. Okay. So what we're going to do here is that then we can start to structure our trade and we can start to plan. Now, if 67 is where we're going to look to enter, then of course my stop needs to go above that swing high. My target 1 will be where this swing low is. And again, you can see the risk reward ratio here is 1:2. Okay. Now, what I can also look out for is I can go back to the higher time frame and I can look for extended targets, right? So my extended target is going to be all the way down here at that previous low, which puts me around 6450. And therefore, I can go back to the hourly and say, okay, if I'm not going to aim just at the bottom here, I'm going to aim for 6450, right? My risk reward becomes 2.5. Now, it's not a very significant increase, but it's 0.5%. I would say 0.5 R more, okay, which in this case is not a lot. But sometimes in certain trade structure, we might have a second target going as high as 1:3, 1:3.5, 1:4, right? But that's the point. Bare minimum, you're going to aim for 1:2, which is great, right? Anything extra, you want to look at it as a bonus. Okay. Now, what we have done so far is I walk you through the directional bias perspective. We walk through the setup phase, which is the process of, what are the conditions we look at. The third part on this DSC framework is basically context, right? So the context of this from a technical point of view is that number one, you look at this overall structure here on a higher time frame. We are in a range kind of environment, right? So that opens up number one, the expectation of this sell trade is not going to be something long term, right? Compared to maybe if the market is at the very top, then we might say, okay, maybe it's a reversal. We want to look for that, or maybe the market is coming down. It's in an obvious downtrend. Then we can kind of like capitalize on the trend as well. But the context of this trade right now is that it's a range environment. Okay, so what does it mean to me is that I might not go for extended target, right? Because if today is a range bound environment, it's not like the clearest direction. I'm not really leveraging on the directional overall. If I can actually squeeze out 1:2 risk to reward ratio from the market in a range kind of structure, I'm more than happy, right? So that starts to build in the context. Now, what I can do is I can also look into fundamentals context, right? Now, is there any particular kind of a news that is related to Aussie and dollar coming up, right? Now, if there isn't, fine, then that is being covered, right? But if there is, then maybe I want to be a little bit careful. Okay, maybe um, I want to observe first, how the news is being released and things like that, right? So again, context is quite broad depending on how deep you want to go into, right? But that's the aspect of it. Okay. So again, you can see with the application of DSC, right, the whole process can be very systematic, right? You follow the first step, identify direction. You go to the second step. Do I have a clear setup? If it is, great. I move into the context phase and start understanding, is this trade something I'm very comfortable in? Am I confident in this? Is there something else I need to factor in? Do I need to look in things in this? Okay. So great. So hopefully that's so far so good. You guys are following through, right? But basically, this is a potential setup I'm personally looking at. Okay, so you can see the application of how this is being used in the live environment. Okay, now coming back to before I talk about gold and silver, coming back to answer LKW84 question, right? Do you use the Elliott wave indicator in TradingView? Does it need further setting? Now, I don't use the indicator here, right? Because I understand that this indicator called Elliott wave chart pattern, I don't use that. I don't feel that it's very accurate. But I do use the labeling tool from times to time to just help me annotate the chart. Okay. Now Elliott wave is a very, very complex topic that, to be honest, is not something that you can actually pick up in a single day, right? I've done like offline workshops on Elliott wave topic itself, and one full day itself is not enough as well. I mean, I can cover everything in one full day, but the more important aspect is how much can you absorb, right? How much knowledge can you absorb? How much can you actually apply eventually? So Elliott wave, what I realized, right, as my own personal journey in learning this principle, you need a lot of practice, okay, and it takes time. But to be very honest with you, once you pick it up, okay, you would see the charts in a very different manner, right? Because the strength of Elliott wave is what we call forecasting. It allows you to have the ability to do scenario planning, right? If this happens, how am I going to prepare myself? If B happens, how am I going to prepare myself? If C happens, what am I going to do, right? It allows you to have that ability, okay, when you really understand the principles of Elliott wave, right? So in short, I don't use that indicator. I really feel that it's not very accurate. And the way I apply Elliott wave in my trading is I don't really label a lot of my charts, right? If you realize I do very, very simple labeling, but what I focus more is the patterns that Elliott wave principles have. Okay, and I use those patterns to project what would likely happen, right? If this happens occur, if these patterns occur, what's the odds of it developing next, right? So I kind of use those statistics to help me. Okay. So great. Yeah. So if you have any questions for the rest of you, just feel free to put it in the chat. I may not answer you immediately, but I'll do my very best to make sure I answer your question. Okay. Now, so Aussie dollar is one example that we went through. I want to jump into gold. Okay, which I feel that surprisingly a lot of traders are very interested in gold trading. To be honest, I'm not really sure why, because to be honest, there are also opportunities in other instruments, right? Um, so for me, okay, so I since I touched on this, right, I also want to expand on the conversation about being a swing trader. You can't just focus on one instrument, right? Because you're already looking at a high time frame, and as a swing trader, if you only look at one instrument, then you need to be like super patient because you're not gonna get opportunities every other week, right? So as a swing trader, you need to expand your portfolio and the instruments that you are monitoring so that you get access to decent opportunities that you can actually trade in the market. Okay. So if you want a short card and you just want to be following what I'm monitoring, uh, what you see on the screen right now are basically all the instruments that I'm looking at, and those are the instruments I'm focusing on trading, right? Now, it doesn't mean that other instruments doesn't have any opportunity, right? Because there are some traders who look at, pound cat, euro cat. In fact, euro cat and pound cat, there are opportunities there this week as well, but it's not in my watch list, right? So for me, I don't want to look at too many things, right? But at the same time, I need to look at sufficient things that gives me opportunity on a regular basis, right? So that's what swing trading really is. Okay. Now, so let's come back to gold, right? And then just spend some time to talk about gold as well. Okay. So what I'm looking at gold, again, going back to DSC framework, right? The first thing you always establish is direction. What is the high probability direction that you want to focus on moving forward? So in this case here in gold, right? What we're seeing here is we have this push from the high, the market pushed down very fast, very impulsive. The market pulls back towards 61.8 Fibonacci from this high to this low, and we start to see a very decent rejection. Okay, what does it tell me is that, all right, the market respected this 61 Fibonacci retracement very, very well, and this move down is with momentum. So it kind of opens up the possibility that, all right, if we see a corrective development here, there's a very high chance the market would come down next, right? 60% that would happen. Great. Now I have something I can focus on, right? You can see that thought process. You can see the systematic way of how we approach the market, right? This is all about directional bias. Okay. So now I've established that. Now I've established and say, all right, I'm interested in the downside, right? If the pattern occurs, there's a high probability price will continue lower. Therefore, I established the bias. I'm only more inclined to look out for sell trade setups. Okay. And of course, on the hard time frame here, we can also very, very quickly establish what are the key areas, right? If the market were to come down, where would it likely go next? Then this is where I take this low here as a primary example first, where of course we do have some support area there as well. Okay. So that's the directional bias. Now, once we have that, naturally, the second thing we'll look into is, do I have a setup? Okay. Now, same model. Okay. It's just a repeat of what we covered just now. Okay. Now, if you take a look, go here. Okay. We have this here high. The market went up a little bit and then came down very strong, right? So this portion here is what we call a classic SMC model, right? Why? Because you have this as your liquidity sweep. You have this as whether you call it change of character or break structure. Okay, you have this as your order block. Okay. Now, in this case here, if you pull fibs, okay, depending on how strict, in the details of things, you can see how nicely price actually tagged the 67, right? Of course, the question is whether you make like that slight adjustment, just slightly above, slightly below. Some traders might miss this, some traders might take it, but in any case, it's a perfect example of a model here, right? Which I just want to bring your attention to, the SMC classic model. Now, suppose you miss that, it's fine, right? The market continues lower here. And then what do we have? This is where we have similar setup to the Aussie dollar side of things, right? We have inner trend being established. So we don't need a liquidity sweep anymore, right? What we already have here is a break of structure, very obvious. Okay. And of course, this entire chunk here is basically a fair value gap created. Okay. So on the hard time frame on H1, you can see that's the fair value gap. Oops. Okay. That's a fair value gap. Okay. So what's a fair value gap? Is basically a confirmation criteria of an impulsive push. Okay. So if you see an impulsive push, usually huge candle body, and then when there's a three candle formation, left and right candle did not overlap, that forms a fair value gap. Okay. So then what we are looking at again, pull fib, swing high, swing low. If the market were to come back up towards 67, that will be an area of interest that we're going to be looking into, right? So that will put us around 4,140. The stop can likely go above that swing high, which is 4,215, and then first target here is close to 4,000. Okay. Now, obviously, again, we can apply the higher time frame extended target, right? So 4,000 is basically the swing low. We can go for more. We can say, okay, we're going to look for like 3,900 as our take profit too, as our secondary extended target, right? So same thing, right? If you look at this here, your first take profit area would give you a risk reward ratio potentially 1:2. If you go for 3.9, right, which is your extended target, you can see it goes up to 3.3. Okay. So that's your setup. Okay. You can see again, it's a repeatable, systematic process, direction, setup, and then our context, right? So the context of gold, obviously, if you're looking into the fundamental sentiment aspect, you want to then analyze, right? Is there any major news that might impact what we call a risk sentiment, right? Risk on, risk off, because that will have a direct impact on gold. Now, if you go deeper into context in terms of exposure, then this is where we talk about market correlation. Okay. So if you talk about market correlation, you probably will also understand that Aussie dollar and gold, they are pretty closely correlated, meaning if one goes up, likely the other would follow. If one goes down, likely the other would drop as well. Okay. Now, in this very good example, in this little case here that we're talking about, right? We have a Aussie dollar potential sell, we have a gold potential sell. These two are correlated. Then, from a context point of view, from a risk management perspective, this is where we talk about risk exposure. If I'm going to take both trades, okay, concurrently, my risk is going to increase 2 times, right? Why? Because they're correlated, meaning if I'm going to lose on one trade, then there's a very high chance I'm going to lose on both. Okay, so once I understand this, how do I structure my risk? Do I then filter and maybe say, I'm going to take one, okay, and then I'm just going to ignore the other one? Then I would then limit my risk, okay? The second way I can do things is I can say, all right, I'm going to reduce the risk per trade, right? So initially, if I'm going to risk like 1% per trade, what I can do is I can then reduce that to 0.5, and then I take both. Then I'm also, net, if you add up, it's still 1% risk overall. Okay. So this is again a very important application aspect on how to structure your risk, right? In terms of like market correlation and total risk exposure. Okay, so hopefully that gives you a little bit of clarity into things, right? And of course, again, if you apply the context on higher time frame, again, going a little bit deeper in Elliott wave principles, we have what we call a three wave structure. That's why you see the label here, WXY. right? Most of the time, we can't expect the market to develop in sets of three. And therefore, we expect this to develop in, one, two, three as well, right? So it's a fractal nature, right? You have bigger sets of three, then within it, you also have smaller sets of three. Okay, so that's another one that you can keep an eye on for the week, right? Which is XAU USD, right? So very, very quickly, I see a question here from LKW as well, right? How to know which area of fair value gap to target? Good question. Okay. Now, if you realize my way of structuring a setup is that I don't really look at the fair value gap first. I use the Fibonacci ratios as our primary area, right? Which to me here, I'm using the Fibonacci ratio 67 retracement. Then what I would like to see from my entry area is, do I have a confluence? Do I have an order block or a fair value gap confluence? If there is, great. That's like, a checklist, right? You check, you add a point to that. If there isn't, doesn't necessarily mean you can't take the trade. It's just that, if today I have like 8 points that I want to hit in the checklist, right? If one of it missed, maybe I have like 6 points or 7 points. It's still pretty okay, right? Because majority of that still check it out. Okay. Um, Let me just also very, very quickly give you an idea of what I mean by checklist. Okay. Okay, my com is a little bit slow right now. Okay, but just share with you how I prepare myself. Okay. So this is what I mean by checklist, right? So you can see for me, these are the 5 important checklists. Okay. Not all setups are gonna give me perfect 5 out of 5. Okay. But at least today, if I know that there's 3 out of 5, it's still the majority of it. If today there's only 2, then obviously it's not gonna pass that checklist. I'm not likely gonna take the trade. Okay. So I just show you example of this one here, right? Because today we talk about gold just now, right? Just share view. Okay, so you can see here, gold. This is done this morning, right? I usually prepare my trade in the morning, my plan in the morning, right? So gold as of the morning here, we only have 2. Okay, now, but why I'm still okay to accept it is because, as I mentioned, right, on the lower time frame, it has formed an internal trend. So, as an internal trend, naturally, there won't be any sort of a liquidity sweep anymore. Okay, so it's fine. Okay, I would just take it as this is check as well because it's already an internal trend form. It's already confirmed from a lower time frame perspective that it's a bearish trend. Okay, so out of gold here, you can see this is 3 checked, right? There's no internal liquidity and corrective pullback because in the morning when I'm doing that analysis, even in fact today, if we come back here, we haven't really established what we call an internal corrective pullback. Okay, because ideally, okay, what I would love to see for price to develop going into my areas of interest is that we want this to come up correctively. I want it to come up slow. It shouldn't be too fast, right? If today the market just decides to say, in the next 2 hours, right, it's just gonna give you one huge candle like that, and then the next hour give you one huge candle like that. If the market were to pull back so fast into my entry area, it's not something I'm very comfortable with. Okay. So that's something I'm also looking at as part of my checklist, right? A higher probability setup is when the market pulls back towards the area of entry correctively, meaning it takes time, it's slower. Okay. You don't want the pullback to be too fast. Can follow, right? So that's to answer your question, how to know which area of FVG to target. We don't really focus on that, at least for my approach, right? I use the FIPS more, right? I give more emphasis on the FIPS. Okay, so that's on gold. Now, very, very quickly, I also want to bring your attention to silver because this particular example here would bring up the context component very, very good. Okay. Because all this while for Aussie dollar and gold that I've highlighted so far, pretty straightforward, pretty clear cut in terms of the context element, right? But silver is a little bit tricky, which will give me this opportunity to talk about. Okay. Good. Um, okay. Now silver, right? So same thing, right? We're gonna talk about the framework first, which is DSC, right? So step by step process, right? So first thing is always direction. Okay. Now silver, what do we look out for, right? Number one, um, I would start preempting that okay, this can be a potential very very classic double top. Okay. Now obviously it's not a confirmed double top yet because this neckline hasn't been broken, but I would take it as again as I say preemptive, which means likely that can be a potential double top. Okay. Now, from SMC perspective, this can also be a potential liquidity sweep, right? Some kind of like a fake break. Okay. And then what I see here is this market came down pretty fast recently. That's an impulsive leg. Okay. And if I take FIB from this swing low to this swing high, it's currently testing the 50% mark. Okay. Which from Elliott wave perspective, that is a key level. Okay. Now, key level doesn't mean we're going to take trades from there, but key level means it's like an important juncture for price to make a decision what it wants to do next, right? And for me as traders, key levels means those are the times that you want to look out for as well, because when price comes into this zone, something would likely happen, right? And that's where your opportunity would come, right? So right now for silver, okay, I'm gonna layer in a little bit of context. Now in Elliott wave principle, we always have this baseline expectation of a tree wave, right? Which means if the market completed, or I would say the market develops tree wave, that's a complete set. If the market has yet to develop tree waves, we will expect, or at least we will want to forecast it will likely develop tree. Now, obviously, it's not going to be 100% all the time, but we're going to use that as a baseline, right? So that will give us some sort of a guideline. So today, if we look at this swing high to this move here, right? That is one swing move. If the market were to develop a corrective pullback, because it came into this key area, right? And it tends to have some sort of reaction. Now, if the market were to do some sort of a corrective pullback, then we can forecast and expect the next development, which is going to be a bearish move, because then this would give you that 1, 2, 3. Okay. Now, if that's the case, what does it mean is that we can look to focus on any potential sell setup. Can follow, right? Then naturally, of course, this area will be an area that we can look to sell. Okay, so that's the context element. That's the first scenario. Now, the second scenario is if price react off this key level and it doesn't do a corrective pullback, it does what we call a V-shaped formation, meaning it gives us a very strong bounce to the upside. Now, what does it mean? It means that we're no longer interested in the downside anymore because this is a key area. The price has given us that information that, all right, it's bouncing up very strong. Okay, so when we see a V-shaped formation, usually we don't do anything. It's not a buy, it's not a sell, we just don't do anything. Okay. Now, what can also happen here is the market can continue to do what we call a crawl. Okay, so these are patterns that we have discussed last week. If it does a crawl over here, we might potentially start to anticipate a deeper pullback. Okay, some sort of a 1, 2, 3 internal. Okay, maybe coming to a zizzle. Now, if this is gonna do a crawl, short term we can look for this. Okay. Now, when this happens, this can also be a corrective, and then we can still look for this. Okay, so we can actually trade it to the upside, and then after trade it to the downside, and then eventually still trade it back up, right? So you can actually follow the waves and the swing of the market. Okay, so the context of things right now is that the market is testing a key level, and we want to observe how the market is going to develop from here. That's the context, right? So in this case, you would see that if today I go down to the lower time frame, okay, it's very similar to gold, right? We have liquidity sweep here, okay, we have break of structure here, or you can see, this form a mini swing high. You have a break of structure here. If you're gonna take fit from this high to this low, it's gonna be very similar to the setup on gold, but the context is very different, okay? Because today, if you look at silver on the forward, the context of things that I've described versus gold, it's a very different thing, okay? Because gold here doesn't have a double top. So the context of gold on the higher time frame is we're anticipating a three-wave move, okay? The context on silver, because this has established this top formation here, we don't have that lower high. Okay, we don't have that piece of information that gold has, right? So this is the application of context, right? But of course, you realize that there's a lot of like um other elements that I'm adding in, right? So obviously, if today I don't want to overwhelm everyone as well, right? I don't want to scare everyone, but of course, today if you're fairly new to trading, um, it's not something that you would develop overnight, but it's something that I feel all traders would need to have some sort of like an idea of what you need to do to really reach that confidence and to achieve that kind of consistency in your process, right? And again, going back to the framework of DSC, it really provides you the framework to know what you can work on. All right. So between these two, right? Again, gold and silver, they are very, very much correlated. Between these two, which would I be focusing a little bit more? Which one would I have a little bit more confidence in, in executing any trades right now? Would obviously be gold, right? Because I've established and I shared with you the context of silver here is we really want to see how things are going to develop from here before we jump into any conclusion, right? So far, I can follow all this. Okay. Now, I've only looked at three pairs. And of course, we know we take quite a bit of time to really walk through these three pairs. Um, and then some of you might be thinking, wow, that's a lot of work. But honestly, why we took this amount of time to go through these three pairs, because I really want to establish the clarity for you, right? I really want to see how it's being applied. So it's not some theory aspect, right, that we talk about. It's something very, very practical. Okay. Um, when I do my own analysis and daily plan, trade plan in the morning, obviously I'm not gonna spend 1 hour for three pairs, right? Um, just to give you some ideas, generally when I look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, right? Look at about like 12 to 13 instruments. On average, is about 1 minute ish per instrument, and then I'm done, right, with the analysis, including the entire framework. Do I have a setup and things like that? So a typical routine in the morning takes me about like 20 minutes to maybe 30 minutes. If I'm gonna have a trade, I need to calculate the lot size to put it in and things like that. Yeah, it's gonna be about 30 minutes, right, to go through the entire list, right? So obviously, depending on where you are as a trader in your journey, there are definitely a lot of things to work on, right? But I would want to give you that sense of encouragement more than that overwhelming feel, right? But at the same time, I want to be very transparent, right? Where it's not something that you come in, take a few days of learning, and then eventually you just suddenly became a consistent trader, right? The skill set that you need to develop obviously is something that you need to spend an effort and time to develop. But I always share traders, once you develop that skill set, it's with you forever. Okay, because no one else can actually take that away from you once you develop that ability. Okay, so it's something that is definitely worth developing, right? The thing is, you don't want to be rushing things through. You really need to go through the whole process to become the trader that you should become. Okay, so I do hope so far so good for today's session. Um, I'm not sure how you guys are feeling, right? Is it like overwhelmed? Is it okay so far? But if this is the very first time you listen and you hear about DSC and you're not sure, what's the Elliott wave principles, you're not sure what about SMC model, it's common because today we did not spend time to dive deep into that. We did that last week, but if you miss it, it's fine because next Tuesday, we're also gonna have another live session where I'm gonna talk about the details of the entire DSC framework. What's Elliott wave principles that we're using? What is the SMC model that we're using? Okay, so if you're really into this, I would strongly encourage you to join us next Tuesday. Let me very quickly, since we're on that, right? I'll bring up the poster on that. Okay. Shucks, where is it? Okay, I think it's here. I've downloaded it just now. Give me a moment. Let me pull it up. Okay, it's here. Okay, so next week here we're gonna talk about risk management as part of the DSC framework. Okay, again, if you're interested, do scan the QR code to register, right? And of course, if you can't enjoy this entire session, and what we've done so far since last week, um, it would really be appreciative if you guys can also kind of share it with your friends, with your trader friends, invite them to join us in the live session, so more traders can actually benefit from what we're doing here as well. All good. Okay, so before we end off, just a very quick reminder, today's session is sponsored by KVB. Okay, and again, very, very honored to have this opportunity to be invited by them as well. So if you want to find out a little bit more, okay, there are links in the description. Okay, do feel free to click the link. Find out more about KVB. If you need any information, feel free to reach out to the support team as well. And of course, do explore the current promotions that they have, which is quite unique in terms of the switch bonuses, right? Great. So yep, I hope you guys have been learning, at least gain some insights out of today's session. Okay, and all the best for your trading this week and going into next week. And we'll see you guys on Tuesday again. Okay, if you're interested, do register for it. Scan the QR code, and I'll see you guys next session. Okay, so good night.